A business disposes of an asset that has previously been used to claim capital allowances. The Income Tax Act 1967 requires a balancing adjustment. This adjustment ensures that the total capital allowances claimed over the asset's life do not exceed its actual cost, preventing any tax loopholes. There are two possible outcomes: a balancing allowance, which provides an extra deduction, or a balancing charge, which adds to taxable income. Type of adjustment depends on the relationship between the asset's residual expenditure and the proceeds from its disposal. This mechanism is crucial for maintaining fairness and accuracy in tax reporting, and it applies to all assets eligible for capital allowances, such as plant, machinery, and industrial buildings. Let's explore the key concepts and how these adjustments are calculated. Understand balancing adjustments. We need to clarify a few terms. Residual expenditure, or RE, is the value of the asset for tax purposes after deducting initial and annual allowances. Disposal proceeds are the amount received from selling, scrapping, or otherwise disposing of the asset. The balancing adjustment reconciles the RE with the actual disposal proceeds. The disposal proceeds are less than the RE, a balancing allowance arises, allowing the business to claim the difference as a deduction. Conversely, if the proceeds exceed the RE, a balancing charge is triggered and the excess is added to taxable income. For example, if an asset's RE is RM50000 and it's sold for RM40000, the business can claim a RM10000 deduction. If sold for RM60000, RM10000 is added to taxable income. Applying a balancing adjustment involves a few clear steps. First, identify the qualifying asset that has been sold or disposed of. Next, compute the residual expenditure by subtracting the initial and annual allowances claimed from the asset's original cost. Then compare the RE with the disposal proceeds. If the proceeds are less than the RE, apply a balancing allowance. If they are more, apply a balancing charge. Adjust the business's chargeable income accordingly in the year of disposal. It's important to keep accurate records of all allowances claimed and disposal proceeds to ensure compliance. Special rules may apply in cases of business transfers, mergers, or incentive schemes, so always check for exceptions. These adjustments are one-off events, only occurring in the year the asset is disposed of. Summary: balancing adjustments play a vital role in ensuring fair and accurate tax treatment when disposing of capital allowance assets. If the disposal proceeds are less than the residual expenditure, a balancing allowance provides a deduction. If the proceeds are higher, a balancing charge increases taxable income. No adjustment is needed if the proceeds equal the RE. These rules apply to all types of capital allowance assets, and proper documentation is essential for compliance. Remember, balancing adjustments are calculated only once in the year of disposal, and special rules may apply in certain business scenarios. Understanding these concepts helps businesses manage their tax obligations more effectively and avoid unexpected tax liabilities.